before they jump into, investing as a limited partner is they have to get educated 100%,
Absolutely.
right? You
Absolutely.
have you have got to learn the language. You have got to be able to dance around an underwriting model. You have to be able to understand what are some of the things in the underwriting that you as a limited partner investor can stress test some of those assumptions, right?
Mhm.
Just simple things like, organic rent growth in that particular market.
Are you looking to achieve massive success in your life without dealing with costly investment nightmares? If yes, then this is the podcast for you. Here, we provide engineers and busy professionals all the secrets and strategies to create multiple streams of income, build generational wealth, and live a meaningful life by design. Here's your host, Ted Patel.
Hey everyone, this is Ted Patel, and welcome to this week's edition of Decoding Cash Flow Podcast. I'm here with Jeremy Dyer, who is the founder and managing partner of Starting Point Capital. Jeremy leads a company's investor relationship, strategic partnership, and serves as the director of marketing for the company. He has extensive experience in real estate, both as an active and passive investor, and currently he is a passive limited partner investor in more than 29 real estate deals. Jeremy, thanks for coming on the show. It's a pleasure to have you here.
Yeah, Ted, thank you for having me, and I'm looking forward to decoding cash flow today.
We'll surely do. And I'm sure it will be a great show and many good information for our listeners. Right. So before we dive deep into, the passive side of real estate, right? Or active, both actually. Why don't you give our listeners a little bit background about yourself? How did you get started in real estate and what's your main focus as of now?
Yeah, absolutely. I appreciate you giving me that opportunity. So, really, as it relates to real estate, I can go back to actually my college days when I tried my hand in investing in Wall Street through the day trading type of strategy, right? So
Okay.
this is I went to college back in the dot-com, bubble days, right? Where everything seemed to be going up.
Right.
People were having a good time, picking penny stocks and riding them up to a couple bucks, a share, kind of a thing. So I was having a lot of fun doing that. The challenge is when the bubble burst, I lost a significant amount of money, including the fact that I was using my own college tuition to trade stocks, and I was trading those stocks on margins. So when
Mhm.
the stock prices started to decline, Ted, my losses were amplified, right? So kind of fast forward then to getting into my professional career. I was very blessed to be a very high performing sales associate. Really kind of rose to the tops of the class. I ended up becoming the number one guy in all of North America. So I was really, so to speak, crushing my W-2, right? Crushing my day job. The commission checks were coming in my early 20s. I can tell people in my early 20s, I was completely debt free. My wife and I had built our dream home. We had two beautiful children at the time. We had the 40-foot RV sitting in the driveway, ready to
That's
go.
nice.
Yeah, I mean, we were in a really nice spot. Most
Yeah.
people can't honestly say that when they're in their early 20s that they were able to get to that point, but we were fortunate to be able to do that. So then one night, my wife and I are watching HGTV, and we happen to come across, a home flipping station, and thought that sounded super sexy. At the time, my wife had exited from the W-2 world because we didn't really need to rely on her income because I had plenty of it, coming through, my professional day job. And so we decided we were going to start buying distressed properties on the single family side, fixing and flipping them, because largely she was looking for maybe a little bit of a side hustle outside of, taking care of our two boys at the time. She had a
Mhm.
knack for interior design. My dad happened to be a general, contractor. So it really worked out nice. We could put cash, down on single family homes without any debt. We were able to use our leverage with no contingencies to really beat out a lot of other potential buyers, right?
Mhm.
So that strategy was going well, Ted, at the time. However, once we got to 2015, my wife and I decided to double down on children. So we went from two to four. And my older two boys were active in year-round hockey. I happened to be a coach on their hockey teams. And so it was getting to that point now where it was becoming very difficult for us to balance me crushing my W-2 with also trying to build up an active real estate, portfolio and be a full-time dad, a full-time husband, a full-time hockey coach, all those types of things. So something had to give, right?
Yeah.
And so in 2015, we made the decision to exit the single family home ownership business and instead start deploying that capital and new capital into passive real estate opportunities as a limited partner investor. My first investment that I made was in 2015. I'll be honest, I didn't know what the word syndication meant. I wasn't aware of the difference between a limited partner and a general partner. It was more, I knew, like, and trusted the sponsor. I used the shotgun approach. I held my breath. I plugged my nose. I sent my wire transfer in. And thankfully, a few years later, I had gotten my original capital back and the deal had produced over a 2x equity multiple.
And you got hooked into it.
I was hooked at that point. So now if you fast forward to today, Ted, from 2019 until 2024, as you read in my bio there, we're in 29, investment opportunities right now as limited partners. And that spans over 6 different sponsors, a dozen different market locations. We're in a few different asset classes. Most of our portfolio is in multifamily. The remaining is in other asset classes like assisted living, self-storage, flex office, retail, et cetera.
Right, sounds great, man. So you started with active, you went fully passive, and now after this new company, like Starting Capital, you are, I would say, in between active and passive, because you also have to actively, work with to build the investors' relationship. When you started, or initially when you opted going for a passive investment, what were the few criterias or what were the things that you looked into before diving deep? Because of course, it is the first time someone jumping into this type of investment. Or in the other words, I would say, what should people look into when they're doing their first investment?
Yeah, 100%. I mean, obviously the most important thing that any, investor can do before they jump into, investing as a limited partner is they have to get educated. 100%,
Absolutely.
right?
Absolutely.
You have got to learn the language. You have got to be able to dance around an underwriting model. You have to be able to understand what are some of the things in the underwriting that you as a limited partner investor can stress test some of those assumptions, right? Just simple things like, organic rent growth in that particular market, relative to the competitive assets in the area. Understand what a cap rate is, what's the going in and going out, cap rate, and is the going out cap rate realistic relative to, where we think the market's going to be in 3 to 5 years, versus maybe where the market is today. Obviously debt has been a huge, topic in this space for a lot of people because there's a number of, sponsors out there that have some liquidity challenges on deals that they purchased, back in 2020, 2021, and perhaps even early 22, right? So just understanding, what are the different types of, debt type structures that are out there, and do those debt structures really align well with the sponsor's ultimate business plan? And then, beyond getting educated, everybody really needs to assess their level of risk tolerance, right?
That's true.
I can tell you my level of risk tolerance in my 20s is very different than now I'm in my mid 40s. And I can tell you in a decade from now, it's going to even be different then, right? So
Absolutely.
I'm a huge fan of diversification. Within Wall Street, within Main Street, obviously, real estate investing is a huge component to Main Street investing, right? And that kind of overall strategy, which is why I'm in 29 deals now as a limited partner investor in multiple different markets, multiple different investment sponsors, et cetera.
That's right. So you mentioned a few things, right? One is the risk tolerance. Of course, you have to measure the risk tolerance at one. It doesn't happen. Maybe 99.9% time it doesn't happen, but you should be willing to lose the whole everything that you invested at one point of time. You should have that tolerance already built into your strategy.
Yeah, 100%. And the nice thing about, investing specifically in, we'll just say multifamily, because that's what I'm most invested into,
Yep.
is there is a fairly low likelihood that you're going to obviously lose, your capital. And it really comes down to, do you believe that the sponsor, or the lead, operator is going to be able to hit, those projected returns, or perhaps even exceed, those projected returns? Every lead sponsor is going to tell you that their deal is conservative. Okay.
Yeah.
They're all going to tell you that, right?
That's true.
Well, how does the limited partner, know whether, this sponsor that says their deal is conservative and this one says that they're conservative? How do they really know? Right. And a lot of that really comes down to, I hate to say it, but it's that jockey that's riding the horse. It's the pilot, flying the airplane, right? Does that individual have, a good track record, right? Have they done this before? Have they owned properties during the global financial crisis? How did they fare during, COVID? How have they fared since the, SOFR rate went up 550 basis points over a 16 or 18-month period, right? Like how did they dealt with, challenges? Because that's the one thing that's always happening in real estate is there's always, challenges that occur, and how does that investment sponsor deal with those things? And it's not necessarily always the lead sponsor, it's the team that they're surrounded with. Okay.
That's true.
Some sponsors are a team of 2, 5, or 10. Some of them have hundreds of employees, right? That support the mission. Some are fully, integrated on the property management side and the building construction side. Some use third parties, right? All those things are incredibly important, as investors, really make those determinations as to whether or not, sponsor A versus sponsor B, is truly being conservative in their projections.
And of course, mostly it depends on the sponsor, but as an investor also, it's a responsibility of the investor to have, the basic knowledge of this real estate industry, how to, you don't have to, do a full underwriting, but at least you should be able to understand the numbers in the spreadsheet that has been, or in the PowerPoint deck that has been presented to you.
That's right.
Yeah. All right. So right now you said you have invested in multiple assets, right? Multifamily as a primary, and the others. What are the other assets you're invested in?
Yeah, sure. So I'm invested in a few different assisted living properties, retail, flex office, self-storage. And the main driver there again is I'm looking for diversification, right? Which is why I choose to invest in other asset classes outside of multifamily. But I would say in terms of my, limited partner passive investor portfolio, it's about 80%, of my capital is deployed in the multifamily space. That's right. Yeah.
So how do you see the current market? If you compare multifamily versus the other asset class, what do you think as of now, which is performing better for you in your views?
Yeah, I think that is a question that I'm not going to be able to answer today. It's a question that I can answer for you when those deals go full cycle, right? It's really difficult because I don't have a crystal ball, and for some reason I lost my magic 8 ball a few weeks ago, right? So real difficult, for me to determine, which one's going to perform better than another. And really a lot of that comes down to some of the things that I was explaining to your audience before. And that is, it really comes down to the sponsor, right? It comes down to the market location that they're located in. It comes down to, where the market is headed, right? Real estate traditionally has moved very slowly, but things have really accelerated in the, real estate space, within the last, 2 to 3 years because of the historic run up in interest rates. So, a lot of valuations in commercial real estate in general, not specific to any specific asset classes, but a lot of those valuations are going to be determined based upon where interest rates are headed, right? And that's a big thing, right? That's kind of that uncontrollable. We can't really control, where that's going to head. kind of view interest rates in a couple of different ways. It's kind of that Jekyll and Hyde story. On the one hand, I want interest rates to come down so that valuations on the 29 investments that I'm in increases, right? Cap
Yeah.
rates compress when interest rates, come down,
Come
right?
down. Yep.
Valuations go up. On the other hand, Ted, I, as well as all of your listening audience, have lost a tremendous amount of our purchasing power in the last couple of years, specifically because of inflation, right?
Yeah.
I have this conversation with my kids all the time. In fact, I asked my 17-year-old son, how much is a McDonald's value meal today? $8.50. Well, I can tell you 25 to 30 years ago, it was $3.
That's
Okay.
true.
I can tell you right now that if I go to my local grocery store and I buy a carton of eggs, it's going to be $8 or $9, okay, for the organic ones.
Yeah.
Well, I can tell you 2 years ago, it was $4, right?
Yep.
Everything's going up. So on the one hand, I want my real estate assets to increase, but at the same token, I don't want my purchasing power to continue to be depleted, right? Which
That's
is why
right.
it's kind of that Jekyll and Hyde story, which is another reason why I like real estate, is because real estate tends to, move up over time with inflation, which is why I commonly refer to real estate investing as a hedge against inflation.
And the other benefits also, right? You mentioned one of them. It is a hedging against inflation. The others are like the tax benefits that you get out of it. So maybe well, you can take the depreciation from these investments and tag it under against your, depending on if you have put yourself as an investor on the tax return, you can take full advantage of it and deduct it from your active income.
Yeah. I mean, if you look at the tax law relative to real estate investing, it's clear that the IRS supports real estate investors in a huge way, right?
Yeah.
Obviously, when limited partner investors partner with the lead sponsor to buy a property, right, whether it's multifamily or some other asset class, there's another tax base that's created, right? So think about all of the people that monetize in that transaction. It's the brokers, right? It's the bank, the lender, right? It's the property management company. If we're going to renovate, 100% of the classic units or vintage units, there's a lot of materials and supplies and payroll wages, all those types of things, come in, which is why I believe the IRS provides, for limited partner investors to benefit on the depreciation side. Obviously, depending upon if the investor is a real estate professional or not, they're still able to benefit either way. But for most investors that are not considered real estate professionals, according to IRS rules, they're able to use those passive depreciation losses to help offset, any of the passive gains that they made through distributions or that equity profit split that they receive, at the end when that deal goes full cycle.
Absolutely true. Love it. So the other thing I just wanted to say, check is, you transition from W-2 to real estate. So anyone who wants to do the same, right? Everyone wants to have a passive income on the side. But to make that possible, to do that side hustle and get into that space, it takes a while. It takes education, of course, that's one of them. What are the other strategies a person could implement to transition, or maybe, to get to the point where your passive income is higher than your active income?
Yeah, well, I'll tell you right now, it is not a get rich quick scheme. Okay.
Yep, that's true.
This is an investment strategy that takes decades. It really does, right?
Yep.
But, and you've probably heard this expression before, but the best time to have gotten started as a passive investor was 10 years ago.
That's true.
The
It's
next
always
best-
yesterday.
Yeah, the next best time is obviously today, right? So my strategy has always been, to diversify, number one, right? Number two is to continue to reinvest, right? So to compound. So when we receive monthly distributions from the 29 deals that we're in, as limited partner investors, right? That goes into a bank account. When that bank account balance has reached 50,000, I know that now I've got my next free investment effectively, right? So I'm using the distributions that we receive and the equity profit that we receive when those deals go full cycle to roll that money, into that next investment. And with that type of a strategy over a 5 or a 10-year period, when you look back at where you were versus where you are today, you will start to see some pretty interesting results. But again, this isn't the situation where you can click the refresh button on the Yahoo Finance homepage and watch your investment go up or down based upon, market conditions.
Yeah, this is not an option or a futures or stock market, right? One day it's up, second day it's down. Yeah, it's a steady growth, and as you mentioned, it's not a get rich quick game. It takes a while to build a portfolio. But yes, the end result is you build a generational wealth for you, steady passive income for your retirement, and uh, and when you're diversified into real estate, you don't have to worry about if the stock market is going to be, hitting the bottom when you're retiring. At least you will have the passive income. If the real estate prices also go down, you'll receive the rents for sure.
That's right.
Yeah. All right. So let's talk about the mindset part of it, right? Because sometimes what happens is people want passive income, people want extra money, but to get to that point, you need to have a certain kind of mindset. What was the mindset you had when you started your journey into the real estate investments?
Yeah, I mean, for me, my focus was to get off of the emotional roller coaster, otherwise known as Wall Street. Okay.
Mhm.
So, in full disclosure, I was the guy that was trying to find the next Apple stock, Facebook stock, Amazon stock, right? So that strategy, worked 10% of the time, and the other 90% of the time it didn't, right? I remember having regular communications with my financial advisor, on a monthly basis. What should I be investing into? What should I be diversifying, out of, into, et cetera, et cetera. And it just got to be to the point where the strategy just was not working, right? And so the mindset for me really had to shift, out of the way that I've always been told to do things, from my financial advisor to my, college professors in school, to the way that my parents told me to invest, to the way that my, buddies had told me to invest, was almost always centered around investing in Wall Street or something that's tied directly to the stock market, right? And so
Yeah.
I really had to shift my mindset and say, there has to be a better way. Okay.
Yeah.
Why do some of the wealthiest people in the country and in the world not invest in Wall Street, but rather invest in Main Street, invest in real estate? Why are the rich investing their capital into real estate? And that was really the aha moment for me, is there's got to be a way for me to do it. And for
Yeah.
us, it just happened to be starting with single family homes on the active side to learn the business, and then pivoting later into doing it, passive through a syndication.
That's true. Because what I have seen is people who are involved in 9 to 5, who are doing their W-2, first of all, they lack time. They don't have time to explore different opportunities. And Wall Street, it's like click of a button. You go to the website, E-Trade or, Robin Hood, wherever right now, just buy and sell. So that's the easiest thing, they can do in the limited time people have. People want to invest in real estate, right? But the thing is, they don't have time to actively manage the portfolio. Some of them do, some of them don't, because of course, when you buying your own property, it takes a time to, manage the property. Once it gets from 1, 2, 3, it takes a lot of time and effort, right? So many investors, I would say, or many W-2 employees, they are not aware of the model of this passive investment, how they can just, invest with the operator. They take care of everything, managing the property, distributions, finding the new property, selling them, at the end of the period, 5 years, 7 years, whatever the strategy is. And they're not, many of them are not aware of this strategy where you can syndicate together and buy a property.
Yeah. Oh, yeah. 100%. And I do explain to investors oftentimes that we'll refer to you as a passive investor, but you are really an active passive investor. And why I insert active there is because everybody does need to spend some time on the front end understanding and learning about this type of investment strategy, right?
Yeah.
I love the fact that I have a lot of people in my personal and professional network that trust me enough to just send in $100,000 wire transfer because I'm involved in it. That's fine, right? But at the same token, I really want you to get educated, really understand, why you're doing what you're doing, why it does help, people to build and grow generational wealth. So there is an active element to it, in addition to the fact that every time there's a new investment opportunity, I really do truly hope that people actually read, through the investment document. They read the, private placement memorandum, right? They actually listen to the investor, presentation. They spend time, doing some due diligence on the front end. So there is a bit of an active, element to it, but I totally agree with you in the sense that, most higher net worth individuals, they lack the time, obviously, to go actively manage real estate, but they even oftentimes lack the time, effort, energy, and education to even learn about how to do this on the passive side as a limited partner investor, which is why it's incredibly important for those that have the ability to invest in real estate on the passive side, that they get to know people like Ted Patel, for example.
As well as Jeremy, right? And these podcasts, these are, I think, the best place to start with. You get a lot of information from people who has been involved in the real estate space for a while, and listening to these podcasts, frequently, it builds up the knowledge slowly and gradually.
Yeah, absolutely. And for me specifically, it really started out, from me, having already invested, in multiple deals from multiple investment sponsors, learned the business. And then for me, it just gradually became, me wanting to tell everybody, right? Me wanting to tell family and friends and those that are part of my personal professional network. And then realizing after I had referred, dozens and dozens of investors into other sponsors, deals and opportunities, where I realized I think I may have something here. I think I could formulate a company, build a brand, which largely is an education platform, right? With a periodic time in which we're going to vet an opportunity and bring those to our potential investors. And we're able to use our leverage by bringing, multiple $1 million checks into sponsors' opportunities, where those sponsors are going to give, our investors a better return profile than if they had gone directly into that opportunity on their own.
Yep, that's absolutely right. So, Jeremy, the other thing is, you manage the investors' relationship side of your business as of now, right? Can you tell us a little bit more on the things that you have to take care of during your while talking to the investors, while creating the filters or, the funnel for the investors? What are the things that you do?
Yeah, in terms of how we communicate with our investors, right?
Communicate as well as attract the investors.
Yeah,
Both.
absolutely. Yeah, there's multiple ways I think, to attract investors. And I really like that you use the word attract, because when it comes to, partnering with investors in opportunities, the last thing that you want to do is chase capital, right?
Yeah.
Instead, we attract capital almost to the point in which we become a magnet for other people's capital, right? And I think a really, big part of that is, continuing to invest in people, right? Continue to invest in them from an education, perspective, continue to provide value, build up trust, right? There's multiple different ways that you can do that. one big strategy that we use today is on social media. Another one, is drip emailing or
Drip
setting up a
campaign.
campaign, right?
Yep.
Yeah. Monthly newsletters, recommending specific books, for people to read, to learn more. Obviously,
Yep.
listening to our podcast, which is what we call the Freedom Point podcast. So there's multiple different ways in which you can do that. But I think
Mhm.
that's probably the number one, most important thing to attract investor capital is really to provide your listening audience with value.
Absolutely right. It's all about education, right? Providing them the right education. I would say the informed investors are the best investors. You don't want someone who doesn't understand the business get connected with you and then start chasing you after a while, and you have to explain all minute details to him later on.
Yeah, absolutely. And it doesn't just stop there, right? When investors make that, decision to invest their hard-earned, money into a deal, you got to keep communicating, right?
Yeah,
Let them know that the funds were received when their wire transfer came in, have them ask any questions related to the language, that's in the PPM agreement, that
yeah,
they're signing, right?
absolutely.
Letting them know when you close on the property, providing them with transparent information on a month by month basis as to how maybe the renovations are going, how the property management is going, giving investors access, not that any of them are going to read it, but at least giving them access to all the same level of detail and financials that you're providing to the senior lender on the bank, right?
Absolutely.
Which they're getting all the information. So why
Yeah.
not provide your investors with access to that very same level of information that the bank who's providing that senior loan on the property is receiving?
Yeah. Okay. All right. So Jeremy, I love to keep on going, but want to be mindful of your time also. So before we jump to the final round of questions, is there anything that you would like to add or tell to our listeners?
Ted, this has been wonderful. I wouldn't say that I have anything more to add, but I really do appreciate, the opportunity to spend some time with you today. So I appreciate that. Keep up the good work.
Yep. We'll, of course, because what we do also, right? I'm mainly into ground up construction. We are also multifamily syndicators, but we started with ground up construction. Actually, I started with fix and flip. Later on, I jumped to luxury single family construction and as well as small multifamily ground up constructions. That's what we do right now. So, and back in 2018, we pivoted, I would say, uh, not pivoted, not fully pivoted, but we ventured into multifamily syndications also. So yeah, it's whatever information you give, it's spot on, exactly uh, what people or investor needs to take care of before starting investment with anyone, any of the operators or partner with the other limited partners like you, me, anyone. And yeah, so far it has been great journey, and hope it it continues the same.
Yeah, absolutely.
Yeah, yeah. All right. So you ready for the final round of questions, Jeremy?
Let's have it.
All right. So which is the one book that you'll recommend to our listeners which had the most impact on your life or on your business?
Yeah, absolutely. I'm a really big fan of a book. And if anybody that already knows me is listening to this, they've already heard it 1,800 times. And that book recommendation is The Hands-Off Investor. The
Mhm.
author's name is Brian Burke. Again, The Hands-Off Investor by Brian Burke.
I haven't read the book, but yeah, sure, I'll put it on my list. All right. And what is it about? Like, just if you want to just give a one-liner on the book.
Yeah, absolutely. It's really talks a lot about the differences between, being an active real estate investor and being a passive, hands-off real estate investor. And the book has a special emphasis on how important it is to truly vet out the sponsor And the sponsor and that evaluation process is far more important than the actual property itself, the location that that property is in, and certainly a lot more important, than the IRR and equity multiple projection, that's on the deal deck.
Right. Okay. Moving on to the next question. What is one of the best business or investment advice you'd like to give to our listeners?
Yeah, I kind of already mentioned it on the call here today, but like I said before, I'm a real big fan of diversification, right? So I would never tell somebody to, sell their 401k plan and throw it all into real estate, right? So that's not what I'm saying. I think it's really important for most investors, to participate in their company sponsored 401k plan if they happen to have one available. I think it's really important that you have a relationship with a financial advisor. But I also think if you don't have cash flowing real estate, involved or as a part of your overall investing strategy and portfolio, that you really ought to consider.
Yep, that's true. All right. And what are the main source of information for you to learn and grow?
Yeah, I would say this podcast. Okay. So the podcasting space has been incredibly transformative to me. I probably listen to way too many hours of podcasting every single week, but it has really allowed me to go from being an active real estate investor to passive, and then further, staying up to date on industry markets and trends and speaking the language, right? It's really accelerated my learning, path to get me to a point in which today, where I feel much more comfortable, talking with others about real estate investing as an overall strategy, and really enabling me to become really kind of an authority figure, in the space. And I largely attribute that to, the fact that I had mentors, but at the same token, I continue to immerse myself, in the business, in the language, and really truly learn from others. And I'm not against people spending thousands and thousands of dollars, on attending, weekend real estate conferences or meet and greets, right? But at the end of the day, the information from an education perspective is largely all out there for free, or it's in the price of a very, inexpensive book, right? You can go get that information and truly learn it yourself. However, in order to do that, you first have to take action.
Yeah, that's true. And of course, a book is one of the place where you can get the information. The other is network, right? You don't have, as you said, you don't have to spend thousands of dollars. Just build a network around you of the like-minded people who are into the real estate world. Just chat with them, get some information, and the ball will start rolling for you.
That's right.
All right. Jeremy, final question. How can Decoding Cashflow listeners get in touch with you?
Yeah, thank you for asking. So I am relatively active on LinkedIn. You can find me there under Jeremy Dyer. Also, you can certainly head over to our website at startingpointcapital.com. Again, that's startingpointcapital.com.
Awesome. Thanks a lot, Jeremy. It was a pleasure having you on the show. And I'm sure our listeners has taken some notes and will act on it.
Yeah, thanks for having me, Ted.
All right, thank you.
Thanks for listening to Decoding Cashflow, brought to you by Aster Capital. If you found value in this episode, then please share it with someone who you think could benefit from it. And make sure to act on what you've learned. If you want Ted Patel to personally help you reach your goals, then feel free to set up a one-on-one call with him. Also, visit us at astercapital.com for more free resources. Content of this podcast is for informational purposes only. As always, please consult your own advisor before making any investment decisions or setting a course of action. Thanks again for joining us on this episode of Decoding Cashflow, and we'll catch you in the next episode.